and gentlemen, the upcoming session is Thailand's Monetary Policy Challenge, How to Manage the Risk in Changing Global Environment. We are truly honored to have the Governor of the Bank of Thailand, Dr. Sethaput Suthiwartnarueput, to share his valuable insights. Dr. Sethaput is the 24th Governor of the Bank of Thailand and board members of the National Economic and Social Development Council, the Securities and Exchange Commission, and the Insurance Commission. He brings extensive experience from senior positions in both public and private sectors, including service on the Monetary Policy Committee. Ladies and gentlemen, may I now invite Dr. Sethaput on the stage.
Sawadee krap, distinguished participants. First, let me thank the Stock Exchange of Thailand for having me here to share some thoughts on the overall macroeconomic picture and what it means for monetary policy. But before I start and look forward, I think it's appropriate to try to look back a bit and think about what things were like when I was last here. I think I was here virtually, though, speaking to you in August of last year. If we look back last year, the macro picture at that point was, we had undergone this period of fairly steady disinflation. We had brought inflation down from 8% down to ballpark, it was about 0.8, 0.9%. And when I spoke to you, it was about, we felt that, we had got the inflation down under control, and the picture was one of this slow but gradual recovery, right? Slow because, again, we were hit very hard by COVID, but, we saw things continuing gradually. With the benefit of hindsight, I chose a good time to speak as I spoke to you in August, but what we saw after that was that fourth quarter numbers came out and they turned out much poorer than expected. When we at the Bank of Thailand, along with actually pretty much all the economists and analysts out in the market, were surprised by the drop-off in the fourth quarter. We were expecting this kind of steady, slow but steady recovery in the fourth quarter, but what we ended up seeing in the fourth quarter was this sharp drop-off. And that fourth quarter GDP of last year contracted by 0.5% on a quarter-on-quarter basis. And I mention this because a lot of the recent downgrading of forecasts and whatnot was triggered by that slower than expected, poorer than expected fourth quarter outcome. And if you look at what was underlying that poor fourth quarter outturn, good chunk of it was due to delayed budget disbursement. Another part of it was due to a rundown in stocks and also a delayed export recovery. I mentioned this, talking back about history, because at that point, when we looked at it, we felt that the recovery was still intact and that short, sharp drop-off was likely to be temporary. And when we looked again, looking back again, we saw that, indeed, after that fourth quarter drop-off, things slowly started to come back. Actually, we saw first quarter numbers come in. As you know, we had a first quarter number, quarter figure of 1.6%. 1.6% doesn't sound like a lot, but again, coming from a drop-off of 1.5% fourth quarter and a pickup of 1.6%, that's a significant increase in the momentum. And then we saw, again, a continued recovery, albeit slow and slower. The second quarter number that came out in terms of quarter-on-quarter was about 0.8%. But the point is that a lot of that, that downgrading of forecasts and whatnot that we saw was driven largely by what happened in the fourth quarter. But the overall picture, I think, of this slow, admittedly slow and slower than we would like to see recovery remains intact. And a lot of it, again, I think is got to do with these factors which hopefully will dissipate going forward. If you look, for example, at the cumulative impact of the delayed fiscal disbursement from fourth quarter of last year and first quarter of this year, cumulatively that added about 0.8% of GDP, so a big chunk. But again, we expect that those delays to not happen going forward. And again, the picture again is one of a gradual recovery going forward. Second half this year, looking ahead now, the momentum of the recovery in the second half compared to the first half is actually likely to taper off because we saw this, again, in terms of momentum, a significant pickup in the first half. So growth will continue, but likely to slow down a bit in terms of momentum. But we'll probably close off the year. Our latest public forecast that's out there is a 2.6% headline GDP growth number, which again is pretty much in line with the other government agencies and a lot of analysts out there, right? And we'll talk about whether that 2.6% figure too high, too low, what that means later. On the inflation front, the latest outturn in inflation, July numbers came out at about 0.8%. Again, that's below our inflation target range of 1 to 3%. But again, we see inflation slowly recovering and getting back within our target within the fourth quarter of this year. The second half of the year as a whole, the inflation should come in at above the target range slightly. But closing off, given that the first half of the year inflation came out lower than expected, we close off the year at about 0.6% headline inflation. Lower than a target, but is this like a huge worry for us? I have to say that the key thing about these inflation targeting frameworks, both in Thailand and elsewhere, is not so much about trying to get the inflation down to a particular precise exact target, but trying to keep inflation anchored into a low inflation regime and keeping inflation expectations and everything anchored as well. And I think if you look at the surveys of inflation expectations, the actual outturns and whatnot, in that regard, it's intact. The thing obviously we do not want to see is that there's this broad deflationary impact on the economy. But again, there are very limited signs of that. If we were going to see broad-based deflation, you would expect to see, broad-based decline in prices in the consumption basket. We don't see that. Most of the decline in prices is concentrated in a relatively limited number of product categories. And you would expect to see, a sharp slowdown, even negative consumption growth, because if people expect prices to drop, they don't spend, prices drop even further. You get stuck in that deflationary loop. We don't see that in Thailand, right? You don't see that negative wage price spiral. Don't see that here either as well. So again, that the risk, even though inflation is coming in and below the target, it does not mean, and we do not see any signs of this, that there's this broad-based deflationary cycle taking place. So what does this mean? That's the kind of the picture on the kind of macro front. What does this mean for monetary policy? We had, as probably many of you know, a Monetary Policy Committee meeting last Wednesday, August 21st, and the Monetary Policy Committee at that meeting decided to vote to hold rates steady at 2.5%, 6-to-1 vote. And 2.5%, I know, every time it's reported in the press, it's always said it's a decade-high interest rate in Thailand. Yes, a decade high, but also albeit pains to point out that it is also among the lowest policy rates around the world. And I can think of only 3 countries around the world where the policy rate is actually below us right now at 2.5%. But be that as it may, in terms of the outlook for monetary policy, what we've been communicating, I think, steadily is that in deciding monetary policy, we will be outlook dependent rather than data dependent. Subtle distinction, I know, because the data obviously informs the outlook, but I think it's important to try to see what because again, data comes out with a lag and policy happens with a lag. If you overreact to the latest data, there's a chance that you will overcorrect in one way or the other. So we try to emphasize and base our decisions on what we see the outlook happening. And in terms of outlook, as we've, I think, communicated fairly steadily, consistently, I should say, there are 3 things that we look at. Okay? First, obviously, is the growth outlook. And on growth, as I mentioned, again, this year we expect headline coming in at about 2.6%, next year about 3%, which is broadly in line, again, with roughly where our long-term growth potential is. Okay, which based upon our latest studies and estimates, it's coming in at about 3 sub a little bit. It's not a great number. And don't get me wrong, we're not happy with the fact that our long-term growth rate is potential is at that reduced level, because it's not enough to lead to the increase in living standards and welfare that we feel is necessary. It's low relative to our GDP per capita. So certainly we'd like to see higher long-term potential growth rate. But that stuff can only come if we undertake structural measures, right? There are structural reasons why our GDP potential growth rate has been declining. A lot of it has to do with demographics. Previously we had labor force growing, and as many of you know, that's no longer the case. We have a situation now where the labor force is actually shrinking. So if you want GDP to go up and your labor force is shrinking, the only thing you can do is increase your productivity. I mean, there's no way about that. And so the things that we would need to see there, again, would be more investment and improvements in technology resulting in labor productivity. That's the only way that you can sustainably increase our long-term potential growth rate. Barring those structural reforms, it's hard, regardless of how much stimulus we inject into the system. Yeah, you'll get a short-lived blip and whatnot, but it's not going to be sustainable. And what we really need at this point is a sustained increase in the long-term growth rate. So, on the growth front, again, 2.6% this year, 3% figure next year, not great, lower than a lot of other countries, but again, broadly in line with what is our new normal long-term potential growth rate. On inflation, again, likely this year, 0.6%, next year, something on the order of about 1+%. So coming back into our target range. And again, I think there are a lot of structural factors that point, again, that trend inflation in Thailand is not likely to be that high. And again, that low inflation does not indicate that the economy is slipping into deflation. If you look at some of what these structural reasons why trend inflation in Thailand is relatively low, lower than other countries, there are a bunch of things that one can point to. First off is, like many developing economies, food is a big chunk of our CPI basket, much larger than you see in the advanced economies. But we see food inflation in Thailand actually lower than food inflation in other countries, so that tends to bring our inflation lower than what you might see elsewhere. If you look at why the advanced economies have seen such higher and more persistent inflation, a lot of that's due to services inflation, which has outpaced goods price inflation. But in Thailand, it's the opposite. Our services inflation has been much lower than in other countries, and so rather than again acting as a boost to inflation, the low service inflation has caused inflation here to trend to be lower. Rent, in particular, has been fairly stagnant, is kind of a drag on inflation here in Thailand. And I mentioned those things not again that it's a worry. If you ask most people whether they feel inflation is too low, meaning the public out there, I think most people feel that no, the cost of living is increased. They don't feel necessarily that higher inflation is necessarily a good thing for them. But I mentioned it again just to indicate that again that there are structural reasons again why trend inflation is likely to be not that elevated in Thailand, but it does not indicate again the presence of a deflationary cycle taking place. The third thing that we look at in terms of outlook in deciding a monetary policy is financial stability. And this is a trickier one. It's a balancing act. As you know, one of the big challenges we face here in Thailand is the fact that household debt is very high, 90+% as a share of GDP. And the way that you solve a household debt problem is not necessarily to add more debt to the debt that's out there. At the same time, obviously, if credit conditions are tightening too much and it leads to a slowdown, that's not good either. So there's this balancing act that needs to take place in terms of how to address the household debt problem. The problem is particularly difficult to address in Thailand because of the nature of household debt in Thailand, which is quite different from what we see in a lot of advanced economies. If you look at the structure of household debt in Thailand, ballpark, about a third of it is mortgage debt. Only a third of it is mortgage debt. A lot of it is either hire purchase debt, autos, which are a depreciating asset, or it's unsecured stuff like credit card and personal loans and whatnot. So unlike in a lot of other countries, right, if it's a lot of mortgage debt out there, one way to kind of get out of the problem is if asset prices pick up, then the leverage decreases and you're better off, the households are better off. But in Thailand, because a lot of this it's not secured by this underlying asset, which has the potential to appreciate, main way you can get out of the problem is to increase incomes, which is not easy and which is not happening as much as we would like to see because, again, of the slow economic recovery and the fact that the slow recovery has not translated into significantly higher income growth. So the problem of household debt is not going to be easy to solve. There's no silver bullet. It's not going to go away anytime soon. And our job there is to try again to manage it so that obviously it doesn't increase, get out of control, and try to bring it back down to more sustainable levels. What is that level? Again, there's no magic number out there, but again, most international practice, good practice on this indicates that something on the order of about 80% of GDP is a level that is more consistent with long-term financial and macro stability. So that's kind of the long-term end target. But again, given the situation, it will take us time to get there, and that will be part of important part of our calculus in deciding monetary policy for going forward. So what kinds of things are top of mind concerns for us on the monetary policy front? There are many. There are many things that I worry about, a lot of things I can't do anything about, so the rational, logical thing is try not to worry about it. So let me focus on the stuff that I worry about, which we can have some bearing on in terms of monetary policy. So let me point to two. First off is that the recovery is very uneven. If you look at it, we see this wide heterogeneity in the recovery. We see this, you look at it by sectors, so you see certain sectors that are recovering quite well. For example, those related to tourism or services related to tourism, those have been recovering quite well. But you look at other sectors, right, particularly in manufacturing, the recovery is much, much weaker, right? You see sectors that are hit and affected by factors relating to China, for example. So there are certain sectors, many of you are probably familiar with things like petrochemicals and whatnot, sectors which used to be able to export to China, but now exports to China have dropped off because China has increased their capacity in those areas by a lot. But not only is that increased capacity resulted in China importing less, they're also exporting a lot more. So they're both companies in Thailand and even the third country markets that we export are being hit by this increased supply from China. So there are these China-affected sectors, which is acting as a drag in manufacturing as well. So the recovery in those sectors is much more muted as well. Autos and electronics are facing, again, also structural headwinds as well. And the confluence of these factors means, again, that a lot of that slow recovery that we're seeing is not just a result of this cyclical slowdown, but there are a lot of structural headwinds that are occurring at the same time that's putting a drag on the recovery and leading to this heterogeneity, that differences in outcomes quite widespread. That's the picture by sector. If you look at the picture by income group or employment group, again, a very wide degree of differences and a wide degree of unevenness in the recovery as well. Obviously, when COVID hit, there were lockdowns and whatnot, those that were employed in salary earning jobs, those of us in the white collar world, we could work from home, right? So we worked from home and the incomes were still being paid and whatnot. But in Thailand, unlike in a lot of countries, there's the share of the labor force, which is comprised of daily workers that are non-wage workers. So these are taxi drivers, right? The merchants, the mekha out there that are again related to tied also the tourism recovery. They can't work from home. So when things locked down, right, their incomes effectively went to zero. And so there was this, even though their incomes now have recovered back to where it was pre-COVID, there was this big hole, this big gap during this period where they had basically no income. And again, keep in mind, Thailand is a country, right, where tourism accounts for, whatever, 12% of GDP, right? Where pre-COVID, we had 40 million tourists a year. And then during COVID, we had this period, this 12-month period, where we had on the order of effectively zero tourists. It was a couple of 100,000 tourists. We went from 40 million tourists a year to a couple of 100,000. So, a huge chunk of income was gone, but those people still had debt, right? So their debt burdens would increase. And so for those people, right, the recovery doesn't feel like it's happening. And again, this gets to my last point on this about the uneven recovery, which I hear a lot when we talk about, when we at the Bank of Thailand say, the economy is going to grow at this percent, whatever the number is, that the recovery is continuing, it's gradual, it's slow. And the reaction that we get very often, is that you say that the economy is recovering, but it doesn't feel that way. It doesn't feel like the economy is recovering. And the reason for that, again, is this is very uneven recovery. It's like the parable of the blind men and the elephant, depending which part of the elephant you touch, right? If you're in the sector that's recovering okay, tourism services, then the recovery looks like it's much more intact. If you're in some of these manufacturing sectors that are being hit both by cyclical problems and, very importantly, structural problems, then you don't feel that recovery. And so, when the data comes out and we see that when the monetary policy obviously acts on the demand side, and then one thing that we've been communicating to people is on the domestic demand side, at least in terms of consumption, the consumption growth has actually been fairly solid in the past. If you look back, consumption last year grew basically at record levels in terms of percentage growth, and this year consumption has continued to grow. But again, people say, I don't feel it. I don't feel it. And again, there's a reason for that. It's because while we've seen that consumption growth happen, we haven't seen that consumption growth translate into production growth in terms of manufacturing. So there's an increasing gap between that consumption growth and that manufacturing production. And where is that coming from? Part of it, again, is that those structural headwinds that I mentioned, the impact of greater competition from China and whatnot. So even though the consumption is growing, it's not hitting the domestic manufacturing sectors and whatnot. And so there's that leads to that disconnect between the macro figures that are coming out and what people feel at a more kind of on the ground level, be it from manufacturing firms or even be it from retail households. So uneven recovery, big issue for us. Second issue is, which we try to flag in the latest Monetary Policy Committee statement, is on macro and financial linkages. And what do we mean by that? Basically that we see signs of a deterioration in credit growth and credit quality. That deterioration in credit quality leads to higher credit risks. So financial institutions are less willing to lend, and that potentially leads to, again, poorer outcomes on the macro front, and then the poorer outcomes on the macro front, again, lead to further deterioration in credit quality. And there's this danger of this negative feedback happening, which we don't want to see. Now, first point to make is that the deterioration in credit quality, that slowdown in credit growth, that was to be expected. Okay, so the issue is really about the magnitude of it and not wanting that effect to take place so much, right, that financial conditions tighten too much from an aggregate or standpoint. So, yeah, the first point to note is that the slowdown in credit growth and the decline in credit quality was expected, right, and continues to be expected. You should expect that going forward as well. Why? As many of you know, there is this thing out there in terms of financial cycle, and we're in the downturn part of the financial cycle. So a slowdown in credit growth is normal and is to be expected. A lot of it reflects the fact that during the COVID, we undertook a lot of credit measures, particularly on the SME front, directed credit schemes, injected a lot of credit into the system. So, you had that rapid growth in credit. And so, now it's coming back to trend and credit growth is slowing down. So in fact, if you look at even pre-COVID levels, credit growth to SMEs was negative, right? As a result of the measures that we put in place during COVID, we got SME credit growth to turn positive again, but then now it's coming back to trend, which is again, after an extended period of credit growth, is a slowdown is to be expected and is quite normal. The second thing was the deterioration in credit quality. Again, we expect credit quality to deteriorate. We expect it to continue to deteriorate, but we do not expect to see it fall off a cliff or see an NPL cliff or anything like that. Now, why do we expect it to see a deterioration in credit quality? If you look at what happened during COVID, given the sharp slowdown in GDP, in incomes, in employment that I mentioned, and you look at what normally should happen to NPLs, the counterfactual that we would expect to see, we would have expected to see NPLs increase sharply during COVID. They did not. Okay, and a lot of that had to do, again, with the regulatory forbearance measures and those that we put in place to try to stretch out, carry people through this COVID period. But it's normal and it's natural that a lot of people that were part of these temporary credit relief measures now start to, reality starts to hit, and a lot, there will be this deterioration in credit quality. Again, but from a macro aggregate picture, NPLs are tracking at about 2.8% relative as a share of total loans. So from a financial stability standpoint, and given again the buffers of the banks and whatnot, we don't expect this to translate into problems at the macro financial stability level. But the issue again is the burden that borrowers will face. And then again, as I'll discuss in a bit later, there are other measures that we should that are to be put in place that will help alleviate this problem. The latest development, so we'll be keeping a very close eye on developments on the credit front. And as I mentioned, the overall credit mechanism, we see credit still growing, but there's certain pockets which are of particular concern for us. So we'll see aggregate credit, for example, to businesses growing. The SME segment, we see contraction in credit. Again, a lot of this reflects increased credit risk among SMEs. And so we feel that the best way to address this problem and address it in a sustainable manner, because we saw this problem in pre-COVID, is not just to inject direct credit like we did before, because that gives you that temporary blip, but to address the underlying problem, which is that high credit risk of SMEs. And so we're very happy to see that the government, Ministry of Finance and whatnot, has supported our proposal to put in place what we were calling a general credit guarantee facility, but basically a facility to try to provide a more flexible and more effective credit guarantee scheme to try to make sure that SMEs continue to get access to credit. And in terms of credit quality, again, we do see a deterioration in credit quality. Initially, that was focused on the lower income households and the more vulnerable households, but we do see signs of that broadening. And again, so we'll be keeping a very close eye on that to make sure that widening or that deterioration of credit growth and credit quality does not derail that recovery that we anticipate and that we would like to see. So those are the things that are top of mind. Those are things that we're keeping in mind deciding our policy. But last point I would like to mention is that while we stand ready to adjust policy in line with the changing circumstances needed, we're not dogmatic. We continue to be pragmatic and flexible, but when deciding these things, we need to look at the overall picture. But we will be guided by behaving in a prudent way and be guided by the lessons, I think, hard-earned lessons about monetary policy that I think central bankers have learned, not just in Thailand, but I think from around the world. And what do I mean by that? If you look at the past decade, it's been a decade where a lot of unanticipated things have happened. Been a lot of shocks. There's been a huge amount of uncertainty, right? If you look back, we went from a period where we had stubbornly low inflation globally, right? And central banks are trying to get inflation up, doing everything they could, but difficult to get it up. And we had, again, conflict in Ukraine, right? Inflation spiked, and in a lot of advanced economies, inflation was stubbornly and persistently high for quite some time, and it took a long time to try to get inflation back down. So a situation where we went from different extremes, a situation where we experienced a lot of shocks that were very difficult to anticipate. So the fact that you have all this situation where, again, a lot of uncertainty out there, a lot of potential shocks coming from which are difficult to foresee, I think puts a premium on trying to run monetary policy in a resilient and in a robust manner. Okay. And what do we mean by that? Robust meaning that it is a policy that is appropriate for a wide range of outcomes, a wide range of possible outcomes, because you don't know what's going to happen, right? So you want to try to set policy to take into account that you don't know what's going to happen with the world. Things could turn out one way, but they might turn out another way. So trying to set policy in a way that's appropriate for a wide range of outcomes, I think, is important for that resiliency and of the economy, and to help ensure that the policy regime the policy framework is is robust. Which means, right, that ex post, after the fact, right, policy might not be optimal, right? Because when things turn out and they're different from what one anticipated and whatnot, yeah, maybe with the benefit of hindsight, you should have done X or Y in the policy regime or not. But again, given again that there's this wide range of possible outcomes, trying to set policy in a way that is, the term I would use is being roughly right under many circumstances is better than trying to get it, exactly right, and you end up being exactly wrong. So one of the lessons, I think, of monetary policy looking back over the past decade is, both in Thailand and elsewhere, is the importance of preserving optionality. You don't know what's going to happen. So you don't want to constrain yourself excessively. You want to give yourself room to maneuver. What does that mean? It means, first, I think, you need to be careful about giving too much forward guidance, because things can change, and the forward guidance that you gave to markets could be wrong. And the thing you don't want to do is be caught out on a limb. Right? You saw the world was going to evolve a certain way, you communicated it a certain way, you undertook certain actions a certain way, and then lo and behold, the world changes and you have to reverse course. And part of the reason we feel that's not appropriate is because there's already a lot of noise and uncertainty out there, and we don't want to add policy uncertainty or policy noise out to the uncertainty that's out in the market. It also means that we have to put a big premium on buffers and preserving buffers. If you don't know where the shocks are going to come from, then it's important that you maintain buffers and you maintain policy space. If you know where the risks are and you're a company, then you can find ways to hedge that risk. But if you don't know where the shocks are going to come from, then maybe the best thing to do is try to just preserve buffers to ensure your resiliency. Maybe it's not the most efficient thing that you can do, but it's the resilient thing to do. And the same thing that applies for you in the private sector also, I think, applies to a certain degree in the policy front. Again, in trying to ensure that the policy that we put in place is one that is resilient. So stability, very important. And in order to maintain and preserve that, there are a bunch of don'ts that I would add in terms of in addition to the do's that I mentioned, which is you don't want to add to the noise, again, to the market. We don't want to overreact to the latest data outturn. data comes out, it's noisy. Sometimes it doesn't mean that it's a trend. And I think if we look back at our own experience on this, bears this out. If we look back 2 or so years ago, we saw inflation in Thailand at that point peaked at about 8% headline inflation, the highest in the region, pretty much, in terms of monthly headline inflation numbers. And at that point, Bank of Thailand we were roundly criticized for, not raising rates rapidly, not raising rates, by chunky amounts, and that we were behind the curve, and that we needed to really, really take rapid actions in terms of tightening to try to make sure that inflation came down. But again, when we looked at it, right, for a lot of the reasons I mentioned, structural reasons why we felt that inflation that we saw was likely to prove transitory, which at that point, you remember 2 years ago, was a very unpopular word, right? Because anyone who said transitory was like, you're making the same mistake as, some other central banks out there. But no, we looked at it and we felt that in Thailand, that was the right call, and that we felt that it was important not to overreact to that data. And so we took what we called a gradual and measured approach towards policy rate normalization. And, inflation again. So we raised rates, but gradually, 25 basis points, ending up at 2.5%, raised them 8 times, and then we saw inflation again track back down, and now again below even our target range. But now, again, latest data, right? Q4 that we saw, sharp slowdown in the economy. One response would have been again, this slowdown is persistent, and therefore we should take rapid action and whatnot. But we felt again that again, in terms of balancing the risks and whatnot, we felt that slowdown was a temporary thing, and that we would see again that gradual recovery taking place. And again, I think the events again, as we saw from the first quarter and second quarter numbers, that gradual recovery is taking place. So again, I think just some examples of how not overreacting to data, the latest data, is important. But it does create this risk that, again, the Bank of Thailand, as back then, is perceived to be behind the curve or not taking sufficiently proactive actions. And probably the third lesson, the third don't, is try to avoid doing too much fine-tuning. I think one lesson, for all central bankers is that there are limits to the effectiveness of monetary policy, and that trying to do too much has unintended consequences. And I think this is a tone that's been echoed by a lot of policymakers as well. Last point on the robust policy, mix, is that it is a mix. It is a policy mix. And the interest rate, which gets a lot of the attention, understandably so, is just one element of that policy mix. So one of the takeaways and lessons from past decade of monetary policy is, again, that it's important to complement monetary policy with other kinds of measures as well, as part of an integrated policy mix or integrated policy framework in the jargon of the IMF, and that recognize that the interest rate is just one of those tools, and it's a very blunt tool. A blunt tool which tries to achieve multiple objectives. So one way you try to achieve and strike a better balance is to complement that tool with other instruments. And so what are those other instruments, which again, we've been using as well? They include things on the macroprudential front, macroprudential tools. They include foreign exchange intervention, and they include, very importantly, financial measures, especially in the context of Thailand, debt restructuring. And so, again, given the situation in Thailand where, again, debt is extremely high, and a lot of the problems are not necessarily of a cyclical nature, but of a more structural nature, we feel that undertaking policy measures to address that high level of debt sometimes can be better achieved. That balance that you can strike can be better achieved by undertaking financial measures like our responsible lending guidelines, which are designed to try to encourage debt restructuring for borrowers that are in trouble are a more appropriate tool than relying solely on interest rates as a means of addressing the financial stability issues. So last point I want to make in the time I have remaining is that, so when we look at, again, our policy response, again, give you my assurance that we are remain flexible, we remain practical, not wedded to any particular stance, and we're ready to adjust as the circumstances mandate. But then in terms of a policy response, I think it's important to recognize that the policy response encompasses a wide range of measures as part of an integrated policy package, and not just on interest rates, but there are also financial and other measures that will help achieve the objectives that we set out. So with that, thank you very much.
We would like to convey our deepest appreciation to Dr. Sethaput for his invaluable insight. Thank you very much.